It's a portion of my business that I don't talk a ton about just because I don't operate in it as much, but I do have the ability to originate mortgages in all 50 states. And as such, it would be ridiculous for me not to address that the current administration is floating the idea of a 50-year mortgage as a supposed solution to our housing affordability crisis. Now, this is completely apolitical. I think everybody knows we live in a time where the vast majority of people are just playing team sports with their politics, where if this idea were introduced by their side, it would be a great idea, but if it's introduced by the other side, it's a terrible idea. The question that needs to be asked is it actually of benefit? Does it tackle the housing affordability crisis and help consumers become homeowners? Just like with business loans, the benefit of a mortgage structure comes entirely down to how it's used. So let's just do an apples to apples simple math comparison. Let's assume a $400,000 house at a 3.5% down payment at a 6% interest rate, and compare those at both a 30-year term and a 50-year term. Believe it or not, the difference in monthly payment, even though the term is stretched by 20 additional years, only comes down to less than $300 per month, where the 30-year mortgage would be $2,314 and the 50-year mortgage would be $2,032. Now, for a lot of people, that $282 difference can mean the world. It could include groceries, utilities, however that extra money would be deployed, and that could be the make or break on whether they actually get to own a home. So yes, from a monthly cost perspective, it could be beneficial, especially when you take a look at what the alternative is, which is the ever-increasing rental landscape. However, that monthly savings does come with a cost, both near-term and long-term. When you look at how the amortization schedule of interest works, over the life of the mortgage on the 30-year loan, you'd be paying around $440,000 in interest, whereas with a 50-year, you'd be paying a little over $830,000 in interest on that $400,000 home. Make no mistake, banks will love this 50-year mortgage idea, because essentially they get to double their money on every home purchase that uses it. Realistically though, we know that homeowners do not tend to stay in their homes for the entire length of their mortgage term. And in my opinion, this is where the real cost to the consumer shows up, in the short-term equity gain. Statistically, the average person in the US moves every 5 to 7 years. Some estimates say 7.5 to 10 years, but it's within a shorter range than what a mortgage would be. With that speed of turnover, the accrual of equity in the near term can make a massive difference in your buying power if you're selling your home as a condition of purchase. Using the same example of the $400,000 home at a 6% rate and a 3.5% down payment, by year 5 on a 30-year mortgage, a homeowner would have accrued nearly $41,000 in equity, whereas a homeowner with a 50-year would have accrued just shy of $21,000. And by year 10, the spread is even worse, with the 30-year homeowner at just shy of $77,000 in equity and the 50-year homeowner at just a hair over $30,000 in equity. That is a brutal gap. And this is assuming that the 50-year mortgage would carry the same rate as the 30-year mortgage, which is not likely. Typically, the longer the term, the higher the rate. How do we know this? We'll take a look at today's example of rates. The average rate on a 30-year fixed mortgage at the time of me recording this is 6.34%, whereas a 15-year mortgage is at 5.84%. So the likelihood is that the 50-year mortgage is going to carry an even higher rate than the 30-year mortgage would. So it's not really apples to apples, and it will impact the equity in an even heavier way. The biggest issue I have with this idea is that it does not actually address the root problem with housing affordability, which is that as long as supply is low and demand is high, prices are going to continue to climb. And if this type of loan allows more buyers to enter the marketplace, the demand is going to spike even higher. And then what? A 75-year mortgage is a solution? So back to the use of funds conversation, how can a product like this actually be used for a win? And I mean for a consumer, because the banks are already going to win on it. The unfortunate answer is that all we have left to count on is that home ownership is a hedge against inflation. As long as home prices continue to rise and the dollar continues to weaken, even a 50-year mortgage will allow that consumer to ride that wave, even if it's at the cost of short-term equity. As you can probably tell, on a macro level, I do not like this idea. It doesn't address the root issue at all. And yes, early adopters will benefit from a lower monthly payment, but over time, the prices are going to rise anyway, and the supply just does not seem to be increasing. With that being said, everything comes down to your personal situation. If your goal is home ownership, and this is the vehicle you need to ride in to get there, by all means go for it. Any equity is better than no equity. And if that lowered monthly payment is going to mean more food on the table for your family every month, that in and of itself is a win.